prior to the collapse of FTX, there was hope that maybe we can get some new legislation through the Congress. Maybe there could be a joint bipartisan bill to get a hold of this industry. Obviously, we all know that FTX was spending tons of money trying to lobby Congress and get some sort of pro-crypto legislation through. FTX collapses, and then I think many lawmakers threw up their hands. You're going to see this continued flurry of litigation activity over the next 6 months.
In order to earn money in the past, you have always had to relinquish that money, either in an equity form or in a loan form. And in Lightning, you can earn money without giving the money, right? You assign the money to a liquidity network secured by smart contracts, secured by your own Bitcoin node. And it really is truly unprecedented.
What's up, Sats fans? Welcome to Swan Signal. My name is Sam Callahan. I am your host today.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.
What's up, everybody? Welcome to Swan Signal. I'm your host, Sam Callahan. I'm the lead analyst at Swan Bitcoin. We've got a great show lined up for you guys today. We got Mr. Nik Bhatia. He's the founder of the Bitcoin Layer and the author of Layered Money. I got that book right here. It's one of my favorite books. I read it early on and I reread it. I love the diagrams in it. And then I got Joe Carlasare, who's a partner at Amundsen Davis and a legal correspondent now at the Bitcoin Layer. So congratulations for joining and joining the show, guys. It's great to have you here.
Yeah, absolutely. Thanks for having us.
Thanks, Sam.
Yeah, and welcome to the show. And first off, Nik, dude, I was watching your cousin over the weekend crush it in Puerto Rico, earning his tour card. Man, congrats to him. Congrats to the family. That is super cool, man.
Thank you. Yes, it was a lot of fun. I watched it live with my dad and my brother, and
Nice.
The three of us were just going nuts. His chip in 4 birdies to end it, and
It's crazy.
And yeah, now he has a special exemption for the rest of the year on tour, and hopefully he can use a few starts to secure his tour card for 2024 and beyond.
Yeah, and for those who don't know, he is a professional golfer, and it's Nik's cousin, and it's a big deal. So congrats to him. So let's get into it. I wanted to talk about a lot of different things. Want to talk macro, obviously Bitcoin, regulatory updates. We got Joe here, who's a lawyer, and so we want to take advantage of his expertise there. This morning, Jerome Powell testified before Congress, semi-annual time where the federal chairman comes in and testifies before Congress. And he basically said that inflationary pressures remain hotter. He said that in order to bring inflation down, they'll likely have to keep rates higher for longer and that it will be quote unquote bumpy. The market is now not expecting any rate cuts in 2023 after he testified. We saw like the 2-year yield kind of spike during the testimony. And so I just wanted to get your guys' comments, just like initial takeaways from that testimony. Maybe I'll throw it to Nik and then get Joe's comments.
Sure. So yes, we see the Fed continue to signal for higher for longer. That's the mantra that they've been on for several months now. And front end yields have repriced accordingly. When they broke 4.5 and terminal was already north of 5, it was pretty clear that going from 4.5 to 5 in the front end is something that would naturally occur just due to where policy rates will be in a few weeks and then a few weeks from then. But I think one of the main takeaways I have is the continued flattening of the curve. So an overall reluctance for longer term investors to sell 10, 20, and 30-year treasuries. Yields are still hanging in around 4% on the long end of the curve, making the curve about 100 basis points inverted. And that is just a very strong signal, the market telling you that, yes, we are going to see higher policy rates, but we still don't think that higher growth and inflation expectations are baked into the market on the much longer term horizon. And so that's where I see it. Also, just thinking about risk assets really quickly, the S&P is right smack dab in the middle of this range that it's been trading in for the last year essentially. And there's a big battle going on between bulls and bears, and no side has come out and can claim victory right now. So we have higher policy rates, but risk assets basically hanging in, and but that could turn on at any time, and we really have to watch this area and see if stocks break down, and if they do, um, I expect long end yields to actually come down alongside stocks, which is not what we had last year.
Joe, do you got any comments?
Yeah, I think it's interesting to look at the comments today, and I was only reading them. I didn't see his body language, which sometimes in the aspect of the Fed, body language is everything. But I think it's interesting that his comments, Powell's comments today, came in what I would view as a marked contrast to what he said at the beginning of February. You'll remember that when he had that press conference, he seemed resolute with this narrative and talking point about the disinflationary process has started. Then subsequent to that, we had that sort of NFP number, which we all know there's issues with that, the seasonality aspect of it. But I thought it was fascinating because then he was given another chance to sort of correct that or walk it back, effectively say, would you have done a bigger hike subsequent to that had you known you're going to get this blowout number in, which I think they did know the number. They still said we're going to hold pat with the modest 25 bit hike. But ultimately, what I think now is I think that they're sort of, at least there's a potential for the reacceleration of another 50. I think the market was pricing that in. I think they could go a lot further still than the market anticipates. And I think that this is the first salvo in Powell sort of laying the groundwork perhaps to go even higher than where the market's currently pricing. I don't know if Nik has any thoughts on that, but to me, it's difficult to reconcile the comments both at the last FOMC presser and the Washington conference where he spoke with these comments today. It seems to be at least trying to at least telegraph to the market that we need to be a little bit more aggressive, that we're not as acceptable. We're not as happy with some of the progress they've made. I don't know, just my read on it.
Yeah. No, it seems like things changed a lot in a month.
Yeah.
I felt like he was almost at a premature victory over inflation. I think he mentioned disinflation like over 10 times in the last FOMC presser. And now the market is pricing in a probability about 50% that they will hike 50 basis points next FOMC meeting. And a month ago, that was the probability was around 10%. So, definitely things have changed. And maybe it's because, core PCE came in hotter. These inflation numbers are coming in hotter. But you mentioned that people think maybe the federal funds rate can get even higher than people think today. And that was a big thing all last year, right? Everyone was like, well, they can't raise it too high. The debt, they can't get it up there. But I think it surprised a lot of people. So Joe, how high do you think that they can get the federal funds rate? And what are some of their constraints there?
It's really a guess at this point, right? No one can give you that clear data, but you have to think of things that would act as a check on that. What would prevent the rates from going higher? And some of the indications that I look at show that consumers still are spending. There's been some modest declines in certain metrics, but nothing particularly alarming. No, what I would call red flags. You still see credit growth. I mean, I think January had one of the highest numbers for private sector borrowing among companies, particularly among high yield. That's interesting because, it doesn't seem like the banks are unwilling to lend. So, I still think we've had sort of this implicit sort of bias that, whoa, they can't hike, they can't keep hiking, really, when realistically, I think that there's this cross currents between some of the stimulus policies that are out there and even like things you don't think of a lot. Like one of the, I was listening to a commentator talk about how, the CPI adjustments to Social Security as well as to taxation effectively are providing additional stimulus. Just think about every Social Security recipient in the country got that cost of living increase. That is what 6-7% increase that they're going to use to be able to spend. I mean, you've got liquidity being provided by some sources abroad which I think is, again, running counter to the Fed's efforts. And it was almost, going back a second to what Powell said, it was interesting to me how he seemed to at least be suggesting that they don't look at liquidity conditions in the short run. They're looking more in the long term. He said that at the last FOMC conference, which I think was fascinating. It's almost like why was he unwilling to at least acknowledge what we all know, which is liquidity conditions seem to have gotten better since at least the end of last year. So I don't know what would prevent them from going higher. I mean, listen, if everything keeps humming along, why wouldn't they raise rates higher? I mean, that's the thing. You have to see a significant uptick in unemployment, which again everybody keeps saying is coming. Maybe we'll get it by the end of this quarter, which is this month. Maybe you'll start to see that number pick up. But I don't know. I don't know why the market consistently tries to get to this ahead of itself when it's saying, oh, the terminal rate's in or we're close to being in. It seems to be the constant folly of traders for the last 6 months.
Yeah. Nik, do you have anything to add there?
Yeah, Joe makes great points. I want to think about the Fed's mandate, right? So the Fed has a dual mandate, and we all know that they've been pretty single-minded for the past year plus in terms of where their attention is, right? They're focused on the price level and they're focused on bringing it down. Now, the other side is the employment mandate. And when I think about where nominal rates are and think about how punitive these higher rates are going to be to the housing sector in particular, we see that we've had over half a year of month over month declines in housing prices. We're now at, on a 6-month annualized rate, negative nationwide across all 20 cities in the Case-Shiller. So if you'll allow me to get into the nuance of a specific fixed income issue here. So think about higher nominal rates of the Treasury curve, right? That's going to drive mortgage rates higher. But what are some of the other factors that influence the spread between the rate that mortgage borrowers or home borrowers are paying and the Treasury yield? Okay. Some of those factors include a volatility component, right? And so that volatility component, rates volatility, specifically in mortgage-backed securities, it's not being sucked out of the market by the Fed in QE. It's the opposite. Now, there's not a lot of runoff in mortgage-backed securities from the Fed's balance sheet because rates have gone up. So there are less people that are willing to refi their mortgage. Obviously, if your rate is higher today than what you paid, you're not going to refi your mortgage. And it slows down the runoff of mortgage-backed securities from the Fed's portfolio. But the fact that they're not in the market and suppressing that volatility and being a buyer of mortgages is naturally going to widen the spread that people actually have to pay when they go to purchase a home. And all of that is going to combine to a slowing housing market. The housing market is 25% of the US economy, and it does filter in through employment numbers, construction, and all the like. So when I think about how high the Fed can get in terms of their policy rate, I'm not necessarily thinking, okay, are they going to hike 1, 2, or 3, or 4 more times? I'm more thinking about at what point is the inflection point for the Fed to stop thinking in a single mandate way and start thinking in a dual mandate way. And that'll probably just come with either 1 or 2 consecutive NFP prints that raise the eyebrow, and then the Fed has to stop and go the other way. And if they go too far up, they'll have to actually cut, versus if they were to pause now, they could let, and use this word I've been using, let the market digest what is happening.
Gotcha.
So that's my overall outlook here on policy rates.
Can I ask a question on that, Sam, for Nik?
Yeah. Yeah.
So Nik, what do you have to say about this this idea that's been bandied about how, yes, you've seen some deterioration in the real estate market, but it appears that you have sort of a standoff between the buyers and the sellers, and you don't see significant supply coming on, and that this has contributed to a frozen market, right? You don't have the sellers willing to take a fire sale and discount the prices. You don't have the buyers that are willing to put this, and you really you have sort of this huge bid ask spread that is materializing in the real estate market, which is just freezing things. Do you give any credence to that?
Well, I factor it in, but the prices are less important necessarily than the churn, because the churn is what drives spending and employment. And if people are building and people are supplying the homes with the raw materials, then that keeps the economy going, even if prices are declining. But if the market is slowing, then the churn slows itself and can slow down the economy. So sometimes I feel like we're looking too narrow at a couple hot PCE prints and missing this overall trend that the economy at the center, meaning housing, like one of the main components of the US economy, is broadly going to encounter a year to 2 to 3 year slowdown. And if it's not severe, then we can maybe avoid a really bad recession. But if it's severe, you're talking about a deep recession, rate cuts, and all that. And that could only be 12 months away. And we just don't necessarily see it materializing yet. But I'm focused more on that than like how high they can get policy rates over the next 3 to 6 months, because the curve is telling me, the deep inversion of the curve is telling me that longer term fixed income investors are not actually worried about a couple hot PCE prints. They're flat out not worried about it. Let me just bring one last bond math thing here. If you think about yields at 4% in the short end of the curve with a duration of 2 years, if rates were to go up by 2.5%, so from 5 to 7.5%, your price of your bond would go from 100 to 95, and you would get that 5% coupon and actually end up at par. So rates could go up 2.5% on your 2 year bond over the next year, and you would break even on the investment. That's a powerful carry. It's a powerful reason to own the front end of the curve. On the longer end, in a 10-year, rates at 4%, if rates go up 40 basis points, let's say a duration of 10, rates go up 40 basis points from 4 to 4.4 over the next year, you break even on your 10-year bond, because you get that 4% in coupon and you lost 4% in price, so you break even. So you have a lot less room to worry about rates going up. But despite that, we have a 100 basis point inversion in the yield curve. Investors are still willing to buy the 10-year much lower with much more rate sensitivity. So the deep inversion is the main signal, not necessarily like how high front end yields can get. And that's, just how I'm thinking about the market.
Yeah, no, it makes a lot of sense. Average 30-year mortgage rates are back above 7. And a lot of these people, I forgot the number, but a lot of them have these fixed mortgages that they did over the last 2-3 years, super low. So they're just, why would you move? Why would you move and pay that extra mortgage? So that could just kind of grind to a halt. And Joe, to your point, like, this is all anecdotal, but I know multiple people throughout major cities in the United States who work really a lot in real estate, and they've said that exact same thing. It's like the faucet's just turned off.
Yeah.
And so it's anecdotal, but what I think about with the housing as well is over the last CPI print, it said about 50% of the price increases came from the shelter component, from owner's equivalent rent, and that's a lagging metric. And so we know that the house prices that Nik just said are falling. So does that create a scenario where we could have like a trapdoor effect and have disinflationary pressures over the next 6 to 12 months as this housing market kind of starts to show up in the CPI? Do you guys think that's possible?
Nik, why don't you go on that one?
The housing component of inflation is there's two sides of the coin, right? There's the rental side, and then there's the housing market side. And so with, less supply that can drive rents up, right? And then obviously with a slowdown in housing itself, it can bring the economy down and bring overall demand down, which brings inflation down. So it's really tough to tell, which is going to dominate, and we just have to continue to watch the data and see which force is stronger on the market. Is it a tight supply and higher rent, or is it a 7% mortgages causing a legitimate slowdown in the US economy broadly? And that is in my base case of expectations. I'm waiting for it to materialize, but I'm not moving off of that core thesis because of just where nominal rates are. Affordability is down and the prices are down in the market, right? Looking at Case-Shiller.
Yep. Well, let's pivot a little bit. Let's go to the labor market because it is so important. It is part of the Fed's dual mandate, and it's been really strong, right? So the unemployment rate's at the lowest level since 1969. Right now, there's 1.9 job openings for each unemployed individual, and that's what Jerome Powell just keeps saying. Oh, the labor market's so tight. And this week we have a lot of big labor data releases. We got the JOLTS, we got the non-farm payrolls, ADP private employment numbers. They're all coming out this week. And it's been strong, but at the same time, the headlines you just see over and over again, layoffs, layoffs, layoffs. Meta just announced today that there's a second round of layoffs coming after they already cut 13% of their workforce a couple months ago. And so, Joe, how do you kind of grapple that? Like, at one point you say the labor market's really strong and the data seems to point that way, but the headlines are just painting this picture of doom and everyone's getting laid off. So what's your take there?
So I think that the labor market is strong in certain subsets, right? What you've seen over the last really year since the hiking cycle began is you've seen that the very sensitive tech companies, those particularly sensitive to rates, those were the ones who first had to transition to this period of cutting back, then layoffs. And a lot of the data shows that those folks, particularly, you think of um, your Googles, your Amazons, your bigger shops, the higher end jobs, those folks still got, by and large, some of those demographics showed up to 50% of the cohort that was laid off is still on severance. So that's not showing up in the data yet, right? They're still benefiting from those severance plans. But to your point about, there are 2 job openings for every 1 applicant. If you look at under the hood at what those numbers show, they're largely in service level jobs, right? They're largely in the lowest end of the spectrum. So it's very difficult to get a waiter, right? It's very difficult to get the sort of entry level employment jobs. And those are creating some distortion in the data. Whereas some of the more higher paying jobs, those are beginning to see some of the layoffs in tech and elsewhere. But it still remains relatively isolated into those really interest rate specific companies and sensitive companies. So for me, I think the question is, how quickly does that broaden? Because I do think it does. I think it broadens this year. It broadens outside of tech and rate sensitive companies. And you're going to see, I expect it, to increase. I don't know, if they're going to be able to. I think one of the Fed governors was saying that they wanted to get it by the end of the year to just under 4%. That was a target for unemployment. Generally, that's not historically how it works. Once you start down that snowball down the hill, it escalates pretty rapidly. So we'll see. To me, I still think it's narrowly focused, and I think that some of the job numbers really are deceptive into what industries those openings are in.
Nik, anything to add there on the labor market?
On the labor market, I think that we look a lot at the headline unemployment number, but one of the numbers that I prefer to look at is the employment subcomponent of the ISM surveys.
Mm-hmm.
And right now, we're seeing that is in expansion territory in services, and that's a different services than what Joe is referring to. Joe's referring to like the service staffs and those type of lower income workers. But on ISM services, we're talking about non-manufacturing firms. And so those types of firms, non-manufacturing firms, are in expansion in terms of employment, and manufacturing firms are slightly in contraction, and have been actually for a few months. in terms of employment. So there is a dichotomy in the labor market. I tend to look at those surveys a little bit more than NFP, um, let's say. And I also am looking at ADP private employment numbers as well. Those have shown decent growth and sustained growth as well. So those are a few of the metrics I'll be watching to confirm or deny, the strength, ongoing strength in the labor market.
Gotcha. One thing that I just like struggle with, it's just so crazy to me that you have the Federal Reserve chairman basically saying that he wants people to lose their jobs. And I know it's like part of their dual mandate and it's like at odds with each other, the inflation and the unemployment mandate, but I've never seen it so egregious where they're just like, this is what we want. Like, do you guys remember a time that they're so just blatant, like, hey, we need unemployment to go up? Or is this kind of new for you guys too?
Well, certainly not in my lifetime, but I think that the one thing that keeps them up at night is this wage price spiral, right? And if they don't bring, Powell would not acknowledge that he wants people to be unemployed. He'd phrase it in his bureaucratic speak as that there's an imbalance in the labor market,
Softening,
right? Well, yeah.
softening.
I mean, there's this imbalance, and the wage price spiral. We often look at inflation and sort of discount the psychological aspect of it, that if these prices just become entrenched, if expectations start to change and people just start demanding higher salaries, that can become very sticky and hard to undo, right? That's how you get this wage price spiral where, that's real sustained inflationary pressures. But the interesting thing about this issues with consumer prices that we've been dealing with for the last year is that although you've seen modest gains in wages, I don't think you've seen this sort of sustained wage price spiral, or at least evidence pointing to that would make me think at least that this won't eventually come back to the norm. That doesn't necessarily mean that the prices come down, right? But the rate of change would in fact decline. So for me, to answer your question, I don't think we've seen anything quite as pronounced as this in our lifetime, at least in my lifetime. But I think that it definitely has them concerned and keeping them up at night that there's a potential for this, right? If things weren't to cool off and you got that wage price spiral, that could change the game. And by the way, I think that what Nik was talking about, you would see that reflected in long-term rates. I mean, you would see that at the long end of the curve, and that's one of the reasons why the inversion has me less concerned that this is for long-term.
Yeah.
Yeah, and in terms of the wages and the wage price spiral, what we're seeing is that to your original question, Sam, which is have we seen this type of blatant targeting of people getting fired? The truth of the matter is that CPI at 9% was a 40-year high. And so it's almost natural to expect them to come up with once every 40-year type of rhetoric and even policy moves to combat that, right? We saw Powell doing his best Volcker impression, 75, 75, 75. I mean, like, the tightening was so intense last year, and that was in response to 9% inflation. And so it's still he like Joe is saying, the wage price spiral does still keep him up at night, even though metrics like the deep inversion of the yield curve don't confirm that in the market. The market can be wrong. The market, thought that a pause was coming 6 months ago, then 3 months ago. And, I even tended toward that camp because of my longer term expectations of disinflation and not prices necessarily going down, but reverting to the mean, right? And it's taking longer. And so he has to introduce different type of rhetoric like, hey, more people need to lose their jobs for us to bring down demand.
Yeah. No, I think that's a great point, man. Let's pivot a little bit because I want to talk about how the 6-month T-bill, the yield is now around 5%. And if you look at the S&P 500 earnings yield, it's also around 5%. It's the narrowest spread since around 2001. And so there's like income in fixed income again. and the equity risk premium is really expensive. And the bond yields are rising. They're kind of blaring these alarms, but they're kind of falling on deaf ears when it comes to the stock market. It's been resilient. And so why are risk premiums and these indicators remaining optimistic in the face of these yield spikes, and kind of this continuing hawkish rhetoric from the Fed? Like, these stock valuations are still pretty high, and we've seen this kind of bear market rally. Perhaps it's the beginning of a bull market, but we've seen this rally over the first quarter of 2023. And what do you guys make of it? Given that the yields are high in the short end, why wouldn't somebody just go into that instead of taking the risk and going into stocks?
Well, I'll just state my bias at the beginning, which is I think that the equity market is a historically flawed metric for analyzing the real economy. And I think the credit markets give you far more information. You see very wild volatility in the equity market that doesn't match the economic realities. And there's plenty of historical examples you can point to. But one of the things that makes a lot of sense to me, and I'll quote my green on this, was I think it is a compelling argument, is that an alternative way of looking at 2022 is to look at what effect on portfolio construction raising front-end rates does. When you look at the beginning of the year and the Fed moved to that aggressive, once in 40-year hiking cycle that Nik was just talking about, what you tend to see is this sell-off in bonds, right, because of the hiked rates, and that money has to go somewhere for rebalancing purposes. So through most of the year, you saw the sell-off in bonds. What did that do? That pulled down the equity prices because you had to sell your equities to buy your bonds to achieve the 60-40 construction. And what that did, it caused this historically very negative 40-60 portfolio, 60-40 portfolio result, right? It's one of the worst years. I think you'll know the stat probably off the top of your head,
centuries.
Sam, but yeah, in recorded history, whatever it is. That's fascinating to me, how the rather than an economic slowdown, because we didn't see one, right? We saw two very modest negative prints in real terms, but still quite hot nominally, very tight labor market. You didn't see the typical GDI was positive the entire year. You didn't see the typical hallmarks of a recession last year, but you still saw this violent sell-off. And I think that largely can be attributed to those sort of natural passive rebalancing aspects, which is the dominant force in our markets today, these sort of buy and hold investors with that balanced portfolio. So to answer your question here, like, why are equities holding in? I think that there are still real concerns in the bond market that can you see this, what I would call a capitulation move, at least at the front end, where you see these rates spike and go higher. And is the risk in the bond market still there in the near term for the next 3 to 6 months, right? Until you get sort of the recessionary dynamics that Nik was talking about, middle to later part of this year. Is it safer to hold equities, which at least the equities carry forward some pricing power, right? They can transfer some of those costs to consumers with the higher inflation versus holding out in bonds. So I think that may be a factor in play in why the risk premium's where it's at in the equity market.
When I think about the risk-free, 6-month T-bill yield at 5%, there are a couple things that come to mind. Number one is that we will have a crowding out effect. There will be the marginal investor that says 6-month T-bill at 5% is a great way to store my money, and I'll figure out what to do at the end of the term, or 1 year or 2 year, lock in that 5% yield. And that takes money out of, let's say, a risk asset like the stock market and puts it into the bond yield. And that is a threat for the stock market, for sure. Going forward, especially this crowding out effect. However, stocks and Bitcoin too both respond most importantly to global liquidity. And that's the regime that we've been in since 2007. It's a liquidity driven machine. And so right now, or let's just say in 2022, you had some of the worst liquidity dynamics and one of the greatest liquidity contractions that we've ever seen because of how intense the stimulus had been. But if we look to what's happening this year, Yes, the Fed is still worried about inflation and hiking, and we have the ECB especially very worried, and their inflation metrics are actually peaking now, while ours peaked last year. So you have the ECB going tighter, but the rest of the world is now actually coming away from the tightening and into a more liquidity providing sort of stance. And I do think that the stock market, why is the stock market hanging in? Your question. I believe it's because the stock market is forward looking to better liquidity conditions over the next 6 to 24 months, not just what's going to happen in the next 3 months with the Fed
Gotcha.
or that. And so when the curve is, again, back to the curve inversion, the curve in any curve inversion is a pricing in of future rate cuts, just mathematically speaking. And so that path of rate cuts is a liquidity boost for the markets. Stocks, I believe, are looking forward to that easing of liquidity conditions. And that's something they couldn't see last year. Hence the real intense decline in stock prices.
Nick, do you based on that comment, when you say they're forward looking, are they also forward looking to the likely recessionary dynamics you have facing us in the housing market? I mean,
Yeah.
you think that what's your comment on that?
Yes, and that's the tug of war that we talk about in the stock market right now, is that, on the one side you have liquid, like empirically stocks rally on a Fed pause, but empirically stocks decline going into a recession and for the first few months of the recession. So those two dynamics are there, Joe. I'm right now reconciling it by thinking that the recession will be mild enough, and not that we're in for a stock market rally, but that stocks can hang in or see modest declines. Remember, stocks are still above 10% above their lows last year. So they're
Yep.
in a decent shape, and they could actually give some of that back in a recession and still not enter any crash formation, because the expectation is for boosted liquidity. So I'm not some raging stock bull here. And even when we look at Bitcoin, Bitcoin is looking forward to or is forward looking on global liquidity. So Bitcoin is not at 50,000 because we're not expecting all this global liquidity, or that we're expecting some of it and macro will drive down risk prices. So there's the two sides, and you always have to balance what you think will dominate and assign probabilities too. So if your probability is 50% deep recession and 50% shallow recession, let's say that's your expectation, that the sum of those probabilities are going to spit out a stock market valuation for you. And I think that probability distribution right now is balanced enough to not get longer term investors to dump. But volatility exists at the margin. People are worried. We see that with all this choppy price action.
Yeah, Bitcoin's had a good 2023. I think on a risk-adjusted return basis, it's the highest asset class out of everything. So it's been going well. But I think, to your point, Nick, it's like a sponge of global liquidity, right? So we'll see if that continues moving forward. Joe, let's talk lawyer stuff. I
Yeah.
got you here.
Boring old lawyer
I'm
stuff. Yeah.
Yeah, there's so many lawsuits, there's so many enforcement actions, bankruptcy proceedings, regulatory developments to start 2023. I mean, it's hard to keep track as an analyst. And now that we have you here, I want to ask some questions. Let's start with Greyscale and what's going on with their lawsuit with the SEC, but also just yesterday, FTX just sued them. I don't know if you saw that. I don't know if you have comments. If you could just more broadly, what you're thinking around what's going on at Greyscale.
Nothing directly on Greyscale. Well, let's start with the suit, if that's okay with you.
Of course.
They had the oral arguments today regarding Grayscale's effort to get a reversal of the SEC order denying approval for the spot ETF. And It was kind of an interesting back and forth. They had very prominent litigators representing the Greyscale argue on behalf of Greyscale against the SEC, and the judges asked some very pointed questions. As a general rule, you should never read too much into oral argument because judges, in a lot of respects, they may the reading which way they're leaning based on the questioning is a dangerous proposition. And many times where you face very vigorous questioning, and really what they're trying to do at that point is maybe convince one of their colleagues who may be swayed one way or the other, but it's not necessarily an indication of which way they're leaning. So always take it with a grain of salt how the argument goes. But in any event, the whole basis for the suit filed by Greyscale is they're saying that this denial of the spot ETF is arbitrary and capricious. And the basis for the arbitrary and capricious rule is the approval, actually, of the futures ETF. They say it makes no sense to approve a futures ETF and not offer a spot ETF product because of the fact that these markets are so intertwined. One of the most interesting back and forth, though, was that there was an argument that was actually cited that in the petition for in the registration statement where Greyscale filed arguing that the spot should be approved, they were effectively saying that the spot market, is immune from any sort of manipulation or fraud, given that you had the futures entity in place, that the futures entity would protect it. And they're saying, SEC, you should approve this because the futures is well regulated, that there's surveillance sharing agreements, that the exchange of the CME is, preeminent exchange in the world, and you have nothing to fear because the futures is going to influence the spot. They seem to take the opposite approach in this particular hearing today, saying, oh, no, the spot market can potentially manipulate the futures market. And because the spot market can manipulate the futures market, it's arbitrary and capricious that they're not letting them both go forward. So that was kind of an interesting back and forth.
That's interesting.
Having to pivot your argument on appeal is never a fun spot to be in. But really, there was a long back and forth about really what leads what, right? In this market, we talk about this quite a bit in many markets, not just Bitcoin. What leads? Is it spot or is it futures that lead? And the consistent retort from the SEC again and again was that, listen, the burden is on the applicant. The burden is on Greyscale to show that the spot market, is not sufficiently manipulated, and that the futures market, the surveillance sharing agreement in the futures market, can protect against spot market manipulation. That was the whole back and forth, and they kept repeating on and on about how Greyscale has that burden. They have not shown it. They actually, one of the judges asked specifically a question about, well, what would they need to show? What would be the information that you would require them to show? And they went back to their normal frame. They want, surveillance sharing agreements with markets of sufficient size, or they want to display this relationship, a lead lag analysis, effectively is what they called it, where you could show that efforts to manipulate the futures pricing, efforts to manipulate the spot pricing would be protected against or mitigated against by the regulation and surveillance of the futures market. So we'll see, where we go with this. Again, dangerous to read anything too much into oral argument, but a fascinating discussion of, from an economic perspective, of the dynamics between a futures market and a spot market. And really, if there's potential in the futures market, does that mean the spot market is sufficiently protected against that manipulation?
It's interesting because I remember Fidelity did a lead lag analysis when they were trying to get their ETF approved, and they found that the futures market led it. Obviously, they kind of wanted that because they want their ETF approved as well. But in the comments too, the recent comments, I think from the SEC, they did like 18 of these things, and what they found was it was inconclusive, which I thought was interesting. Because it obviously they want to say the opposite.
It was another interesting.
Go on.
Another interesting aspect of it is that one of the questions that was posed to the lawyer for the SEC was, well, isn't the role of the SEC to prevent and mitigate fraud and market manipulation? And the SEC lawyer kind of dodged for a little bit and eventually answered that, saying, well, no, really, one interpretation, or our interpretation of the Exchange Act, is not necessarily that the SEC has a role of mitigating or preventing fraud. It's really, we want a key role in surveilling fraud, right? We want to be able to detect where there's fraud and then bring effective enforcement actions, or somehow try to seek out who is manipulating, right? Bring them to justice. It's not necessarily that we're approving this structure, this vehicle, the ETP, based on the idea that, well, we're only going to approve it if it prevents any fraud in this. No, we want to know, if we approve this, will there be regulators who can detect the fraud? It's a kind of interesting, view and interpretation of the Exchange Act.
I mean, I kind of sympathize with Grayscale's argument, because I feel like these futures products do track the underlying spot market that they say is manipulated. Like, why would
Once
an
a day.
ETF
Once a day. They have the
Once a
reference
day.
rate once a day. That came up actually during the hearing today. They said, well, look, even if there's potential for manipulating because they have this Bitcoin reference rate. I don't know if you're familiar. It's like basically a combination of various different exchanges. And they say that they'll have the reference rate, but it really only matters once a day. And during the day, intraday, there's no evidence that they put forward in the record that the intraday pricing is somehow causally impacted by the spot price. In fact, they said, they quote the old adage that correlation is not causation. Simply because the spot market and the futures market move together, that is not conclusive evidence that the spot market is causally related to the futures market pricing on an intraday basis, at least.
Sounds like lawyer talk.
It is. It actually is.
Nik, I don't know if you have any comments about just the ETF in general. I know it's been like years and years and years of speculation over an ETF. What do you think would even happen if an ETF was approved? I would think it would add a lot of flows into the ETF, and then it would help the price of Bitcoin. That's part of the reason why I think maybe they don't want to approve it. I think it would break records the first day, but I don't know what you think.
Yeah, it definitely would. We've seen that Bitcoin ETFs or exchange traded products have broken records in other jurisdictions on their first day. Canada specifically. Yeah. But in the end, aside from the proceedings, which Joe is more positioned to speak on, I think that from a jurisdictional arbitrage perspective, the U.S. will eventually come around because of just overall capital flows, and that's actually a very powerful driving force in Bitcoin itself, is that the activity will flow to where it's legal. And if we want exchange traded products of spot Bitcoin, we will allocate to countries that allow that type of activity to take place. So I do eventually believe that regulators will come around. And that's my longer term outlook, and that it would be generally good for longer term adoption. But who knows what that could do to the short term price, right? There might be a buy the rumor, sell the fact, of course.
Totally. No, I think that's right. I mean, for American competitiveness, I mean, the ProShares ETF out of the Toronto Stock Exchange, it broke all these records, got all these volumes. That could have been in the United States, but nope. And Joe, I just throw it back to you one more time. There's so many things going on in the regulatory space around Bitcoin and the crypto, broader crypto markets or industry. And is there a case that you're looking at that maybe not a lot of people are looking at that you think has more broader implications that you just find interesting that maybe isn't getting all the headlines?
Yeah. So there's, I'll just state at the outset that there are not only there's a flurry of civil litigation that's starting right outside of the SEC. Trial lawyers and other smart lawyers are filing suits left and right. Some of the suits that I'm involved with are still coming through the pipeline, but you're going to see this continued flurry of litigation activity over the next 6 months. Everyone I talk to seems to be teeing up litigation across the board. And the SEC is included in that. I think the way to look at this is that prior to the collapse of FTX, there was hope that maybe we can get some new legislation through the Congress. Maybe there could be a joint bipartisan bill to get a hold of this industry. Obviously, we all know that FTX was spending tons of money trying to lobby Congress and get some sort of pro-crypto legislation through. FTX collapses, and then I think many lawmakers threw up their hands. They're saying, with the exception of stable coins, which maybe there's some agreement on, we don't want to touch this industry. We want to let the CFTC and the SEC take care of this, do what they need to do from an enforcement action. And we're not going to disturb this because of the influence that was coming in through the crypto lobbying groups. So I think that you saw that in the end of the year where you got the green light to file many enforcement actions, and I expect that to continue rapidly throughout the remainder of the year. But to answer your direct question, there's no one particular suit. There are a few that I'm just going to mention. One of which is this Dapper Labs suit, which involves the NBA Top Shots, and the key thing for me in that, and I want folks to walk away from, is that in the context of these NFT products, the judge said that in a motion to dismiss, that these things are plausible securities, right? Applying a Howey analysis, he said they're plausible securities. It doesn't mean that they necessarily are, but it means that there's enough to go forward with litigation. And in my world, that is huge, right? If you cannot knock out a case at a motion to dismiss phase, if you can't say there's no plausible way that this case can move forward, that means that many providers, of NFTs launching these types of, assets, whatever you want to call them, they can face scrutiny from the federal court system, and that any litigant, any individual or class that suffered a significant loss can file a suit. And as you know, in litigation, getting past a motion to dismiss and getting to discovery, that is massive. That means you get to depose folks, you get to issue interrogatories, you get to do briefing. It gets extremely expensive, and it is somewhat of a deterrent, I think, from the private sector for those that want to think about launching these tokens. If you know that there's a reasonable probability you're going to face a civil suit if somebody loses money, and you could have to spend hundreds, if not millions of dollars on legal fees defending you, that may make people think twice. Or conversely, you might think that's just the cost of doing business. We're going to be, build into the fact that if we're launching these things, we should expect that we're going to get sued from investors who suffer losses, and we're going to have to fight them and defend them. But at least what I do think is interesting is that it's different from prior years and even prior cycles, where I think many lawyers, perhaps they were confused about the regulatory status. They're confused about, how these things could be interpreted, and they were a little bit more gun shy to file litigation in the ICO bubble and elsewhere. Now I think, the civil attorneys have come in the absence of the SEC being much more aggressive, which they are as well. They're going to step into the void and try to file a lot of litigation. So I definitely think there's a growing space for crypto litigators. It's not going away anytime soon.
It's a bull market for lawyers. The bear market.
Absolutely. Bull market.
For sure. Well, thanks for that color. I appreciate you sharing that. Let's throw it to Nik. Let's throw something that Nik is has a lot of expertise in, which is the Lightning Network, man. Like I remember you wrote this piece, the Lightning reference rate piece that you wrote. Was that like 5 years ago now? It's crazy.
It was 5 years ago.
Yeah, man. I remember reading that and being like, wow, because you kind of brought up this idea of, Lightning enabling a new risk-free rate. And I don't know if you just saw this, but Breeze launched something recently. It's like an open Lightning service provider model where third-party providers can share liquidity, and it allows Lightning to scale more easily. And that, when you combine that with their other product, the Breeze SDK, which enables developers to integrate with Lightning very easily without any technical expertise, you're starting to see the tools that are enabling Lightning to scale and maybe make your vision a reality, which is really cool, man. Because I want to read a little excerpt from this blog. It says, through Lightning service providers, Lightning can generate yield on Bitcoin holdings without transferring custody, without staking. Nothing is being securitized. No one is holding, gambling, or losing anyone else's money. It means to generate returns on Bitcoin today, not just locking it up and hoping that the number goes up. Yield with full sovereignty and full custody. This is the holy grail of crypto, not just even Bitcoin. And so, Nik, it's like we're watching what you foresaw years ago come to fruition. Like, what are your thoughts here?
Yes, it's It's incredible to watch, and a really cool thing that happened a month or so ago. I was teaching a Bitcoin elective at USC Marshall School of Business, where I'm a finance professor, and I'm teaching this elective for the first time. And I got to the Lightning Network section of the course, and I explained Lightning Network, and then I assigned a paper written by River. River Financial wrote a great
Yeah.
paper at the end of last year called, I believe it's called the fourth insights from the
Sam
fourth
Waters, I
largest
think, right?
yeah, insights
Yeah, I
from the
read
fourth
that.
largest node, right, on the Lightning Network. And
Hmm.
in the section on their yield, right, they put like an APY in there, and they said, less than 100 basis points. I believe it was 85 basis points. And then I got to explain to my students that this was my idea, 5 years ago. And then I showed them the paper that I wrote, and I said, look, it's coming true. People are writing about this now. And the idea was always intended to inspire people to think about Lightning Network really in this context. The power of yield without counterparty forfeiture is unprecedented in the financial construct. In order to earn money in the past, you have always had to relinquish that money, either in an equity form or in a loan form, right? And you have to give away that money. And in Lightning, you can earn money without giving the money, right? You assign the money to a liquidity network secured by smart contracts, secured by your own Bitcoin node. And it really is truly unprecedented. I can't wait to see what is next from Lightning, but Lightning now has to be taught within Bitcoin 101. It's part of my mission as an educator. Um, Lightning Network education must be folded in to Bitcoin first principles to understand and explain Bitcoin's role in our society, Bitcoin's role in international finance, Bitcoin and Lightning Network's role in the functioning of a payments network, Lightning's role in Bitcoin becoming a capital market, and having an interest rate complex within it, which Bitcoin already does, but it's pretty decentralized, probably for the good. But as Lightning Network grows, we will see more people publish their yield that they're earning through Lightning. And I do hope and believe that one day that yield will be recognized on a global basis as one of the risk-free benchmarks, or a benchmark, or a reference rate for other capital market activity.
It's crazy to think about, honestly, but it's happening, and it just takes the tools to do it. And that's like props to Breeze for building this stuff. Joe, I've never even like. What are your thoughts on Lightning? Like, are you? I mean, obviously, you're a big Bitcoin bull, and
Yeah.
how have you viewed Lightning the last couple years? Like the growth that we've seen.
My general thoughts are there are a few things more exciting right now going on in Bitcoin than Lightning and the development surrounding it. And what I keep trying to reconcile internally is why you haven't seen more capital allocation to this. I'm trying to picture ahead. Where does Lightning go from here? And as Nik was talking, I thinking early days, I have some clients that have entered into agreements and licenses for providing liquidity to various different entities and providing their Bitcoin. And I'm wondering how professionalized that becomes in the next several years, where there become major companies that are providing liquidity. Love to get Nik's thoughts on that. And similar to the mining space, right? Like, do we sort of still have this sort of mostly retail dominated aspect of Lightning now, but 5-10 years from now it gets more professionalized, and that's going to be really exciting, right? You do have some initial overtures from Cash App and others integrating Lightning, but to be honest, I'm not quite sure how the liquidity works with that sort of with Cash App and those entities. But really fascinating. I mean, like I said, there are very few things as exciting as Lightning right now in Bitcoin.
If you think about how Lightning Network, if I think about how Lightning Network will grow, I look at the number of payments going through the Lightning Network, the amount of, aggregate fees generated. The aggregate fees generated going up comes from usage. So it's still at the core has to come from bootstrapped usage, just like Bitcoin grew because more people decided to download a node, mine Bitcoin, or hold Bitcoin, right? Hodling is one of the oldest use cases, but the more people that came on it boosted the network effect. So as Lightning Network gets more users, more transactions, aggregate fees will go up. This will bring entrants to the market to provide liquidity. We just saw Dorsey and Block announce dedicated Bitcoin liquidity to the Lightning Network that was in previously we assumed to be in cold storage or held in an offline situation. Now it's online and connected with the Lightning Network in smart contracts. They don't have to forfeit the custody, but they can help provide liquidity and just be another player. And I do believe, to answer Joe's question, that you will see dominant nodes. This doesn't mean Lightning becomes centralized. It just means that you will have dominant liquidity players that do drive the fee market down to where the marginal cost of production is if you roll in a profitability factor, and that will set the average rate. And you will still have the ability to route around those nodes, but it'll probably be more expensive. But you will have large, just like we have large dealers in the treasury market, that happens through a combination of free market and corporate favoritism. In Bitcoin and Lightning Network, you won't have the corporate favoritism, but you'll still have the free market dynamics that basically allow winners to win and take market share because they're good at it, because they drive down the cost. And it's a multi-year time horizon. I never thought that Lightning would come and fix every issue and be the dominant force in 5 years. And it's just going to take time, just like Bitcoin is taking time. But to bring it back to my previous point, Lightning is part of Bitcoin 101 now. It wasn't the case 5 years ago.
Sorry, Nik. What do you think are the biggest barriers or challenges for Lightning right now? Is it just liquidity?
No, it's not even liquidity. It's the actual usage, right? Because liquidity is actually, people are using Lightning Network. Like I use Lightning Network. I don't have any problem sending a couple $100 through Lightning Network, and I know that transactions are reaching $1,000 really without much of a problem in Lightning Network. So liquidity is not a barrier. The barrier is the usage itself, right? We have approximately 5,000 Bitcoin, or let's call it 6,000 Bitcoin, right? That's less than $150 million in total that are in the network and using it. And if you scale that up to a percentage of the total Bitcoin supply, is far less than 1% of the size of Bitcoin, right? 1% of Bitcoin right now would be $4 billion. And 1/10 of 1% would be $400 million. So we're not even close to that in total Lightning Network, just capital. And that's not a constraint. It's capacity. That's not a constraint. That's actually due to the amount of usage, and the capacity will grow as usage grows. So really it's adoption. It's not necessarily a barrier. It that's like a headwind, but it's that, will the tailwind continue to drive that growth? And I believe Lightning's UX, the experience of using it, will drive that growth. I use Lightning almost uniformly, and I know that people that use Bitcoin are using Lightning with each other because of how much better it is than regular Bitcoin as an experience. So I believe all that will continue to drive the adoption.
Yeah, I think everything you just said, and then just the complexity of it, still takes a technical person to know how to run a Lightning service, like be a Lightning service provider, know how to open all the necessary channels with the right nodes and keep them balanced. So I think just as tools get developed, that'll help as well, just as we scale. But like you said, it's a multi-year, even multi-decade projects that we're building out here, just like Bitcoin. So Very exciting time, guys. And this was a great conversation. Covered a lot of things. Really appreciate you guys coming on the show. Where can listeners find you guys? Because I think everyone should follow your work, whether it's at the Bitcoin Layer or on social media. So where can people find you?
So I'm at Joe Carlasare on Twitter. Just at and first name, last name. You can also Google my name. My firm pops up. If you have a litigated dispute that is at all related to crypto, licensing, commercial disputes among miners, I represent all of those. So happy to help or find somebody who can help you.
And you can find me, Nik Bhatia, and all of my content at thebitcoinlayer.com, at the Bitcoin Layer on Twitter and YouTube as well. And definitely go subscribe to our newsletter, which is available at thebitcoinlayer.com/subscribe.
Awesome. Well, thanks again, guys. Really enjoyed talking to you, and have a wonderful day, okay?
Yeah, thanks, Sam. Thanks, Nik.
Thanks, Jeff.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.